Hello, everyone, and welcome to part one of our two-part webinar, How to Get a Bank to Give You the Money You Need for Growth. My name is Andrea Frost, and I'm your moderator today. I work on the communications team here at the Capital Masters, and I'm excited to be hosting this session for the Hello Alice community. We've got two incredible panelists coming up. Bob Hernandez is the Treasury, Credit, and Finance Wizard here at the Capital Masters. Over the course of his career, Bob has analyzed and contributed to the closing of approximately $400 million in small business loans. Rich Russakoff is the acclaimed author of How to Make Banks Compete to Loan You Money, the definitive guide to creating a dynamic narrative and top-notch business plan that gives banks what they need to say yes. Together, this top-notch team is going to cover a variety of options and strategies for unlocking the capital your business needs to grow. Before I hand the mic over to our two experts, though, I have a couple of housekeeping items to cover. First, today's webinar is being recorded, and it will be available on demand after the live session. Once the webinar is concluded, we'll email you a link so that you can access the recording. Also, we would love to hear from you during today's presentation. If you have a question for our speakers, please feel free to send it through the Q&A tab at the bottom of your viewing window. We'll save the questions for the end, and if we don't get to yours during today's session, we'll be sure to follow up afterward. So without any further ado, I'd like to kick things off. Rich and Bob, over to you.
Okay, let's bring up the first slide, which is our cover slide. Well, that'll give you a peek on what we're talking about today. The first thing I want to say is banks will not give you money. What they will do is lend you money. And we don't want to give you the idea that you can walk in, the bank will give you money, and you'll be fine. But what we do want to do is share with you today from both our perspectives. My perspective as an entrepreneur since the early 70s when I received my first loan and have helped clients get loans, and Bob's perspective on the banking side on what you need in order for the bank to say yes. And that's what we're going to really focus on today. Bob, anything you want to say before we jump in?
Yeah, there is a way to have the bank give you money, but it involves the police.
And a handgun.
Yeah, well, some people have made a legend asking the bank to give them money.
Right.
But that's not our purpose today. Let's take a look at the next slide. So the current lending climate is very different than where we were a year ago. Now, the fundamentals stay the same, but what we're discovering is, as we're putting together loan packages for our clients, that we have to dot more I's, cross more T's, explain how they've handled COVID. And Bob has probably talked to about 25 or 30 banks through the beginning of COVID up until as recently as today. Bob, what are you seeing is different in the lending climate today?
Yeah, what's really changed is the bankers are they're getting more granular. What I mean by that is they're really honing in deep on the project and the request, and they're looking at how COVID affected the businesses, what sort of reserves the individual applying for the loan has on hand, if any. So it's not just the down payment, credit report, things like that. They're looking at how professional and how detailed the business plans are. They're looking at your industry. So it's more of a, if I do this loan, how can I be sure it's not going to go bad?
For example, when you say the industry, let's assume you say the restaurant industry. If you're in the restaurant industry, for the most part, there are real challenges there. We're helping someone right now through the process of getting a loan for a new franchise, but they're in pizza. Bob, what does the industry say about something like that? And why is that something you can leverage?
You can leverage pizza because most pizza quick service restaurants or QSRs, they are performing better than they did last year. Because under COVID, or even before COVID, what is something pizza restaurants do? They deliver. So that hasn't been an impediment to them. And they have takeout. So because of that, people might have shifted from going to their sit-down restaurant to going to get pizza or having it delivered. And those guys are doing pretty well. And the banks see that.
And while we're talking about food, grocery stores are doing great right now. And they've figured out ways where you can go up to the door, order in advance. Instacart fills your grocery order and they pop it in your trunk. So there are many industries that have done very well through COVID and others that have had issues. Do you want to address that a little more before we move on, Bob, in terms of the other aspects of the current lending client? You're on mute, Bob. Bob, you're on mute.
Here we go. Sorry, I wasn't, the host wasn't allowing me to unmute. Key banking thing, don't hit mute when you're on a webinar. All right, so please state the question again, Rich.
Okay, what I was saying is, before we get on to other things besides the industry and how you get the best possible information to present to the bank about your industry, what other things might you want to point out that are important to knowing how the very industry you're in is going to affect whether a bank will consider your loan right now?
Well, there's a lot of avenues out there that people might not know how to access. One of the ones we use is IBIS World, but that requires a pretty strong business level subscription. But if you can go out into the internet world and pull real-time data on businesses in your realm that are showing sales, that are showing labor performance, operational performance, things like that, narratives on how the industry is doing overall, that can help strengthen your position if you're able to use that information and turn it around and incorporate it in your business plan or your strategic plan.
So here's an example. We're working with a company that is a learning company, and they go into schools and they do what's called STEM. They go in and they work with disadvantaged children and teach them how to do projects. It's actually doing projects, and it incorporates math, it incorporates science, it incorporates communication skills, and they can do 2 years in one. Well, right now, with schools being closed, they have not been able to do what they're doing. However, Andrea was working on putting together their package and saw a report from Kinsey Consulting that said, this is the future and this is where we're going. So be able to do that really adds tremendous credibility to a bank looking at your situation and where you're going.
But at the same time, if I may add in, the banks already know a lot of this information. So think of it as also a test of how well you know your own industry.
So I want to wrap up this slide, Bob, by asking you to comment. The fundamentals of getting a loan are still there. And what are those fundamentals? And we'll be talking more about that. That'll be a tease into the next slide.
Yeah, but I think we missed one thing. Are banks currently lending? Correct me if I'm wrong on that.
We did miss it.
Yeah, and the answer to that is yes. And that would bridge into fundamentals. banks are still going to be looking at your ability to make a down payment. They're still going to be looking at your character, which is indicated by your credit score, but it's not like getting a home loan. Credit score does not assure that you're getting a loan. It's only one of many things they look at. They're going to look at your industry experience. If you're already in the industry and looking to expand, then that can be a plus for you. They're going to look at how well you know your numbers, how credible are your numbers. They're going to compare your numbers to other loans they've done in that same industry. So a lot of the fundamentals, and in particular, are you going to be able to repay this debt either through cash from your operations, or if it's an SBA loan based on your projections and how credible those are.
Thanks, Bob. Let's go to the next slide. What are the challenges of getting financing today? Bob, you just addressed some of them, but let's take a look at it from the banker side. When no one really knows when COVID is going to be over and how that's going to impact the economy moving forward. If you're on the bank side, what are your challenges that I need to know if I'm going for a loan?
One of the first things that most of the bankers I've talked to, and I'm using the term loosely bankers, because I talk to credit officers, which are the decision makers, as well as frontline development officers and relationship managers. One of the first things out of their mouth is, if it's an existing business, is, Bob, does this deal cash flow? That's one of the first things I hear. They're not asking about credit report or what the management background is. They want to know, are you bringing me a deal that cash flows?
What do we mean by cash flows?
Are based on the loan that they're requesting, are they able to make loan payments at a certain multiple that is widely used by most banks?
Could you give us a sneak preview of what the ranges might be of those multiples and how we can figure them out?
Yeah, I mean, in the simplest sense, if you take your tax return or your profit and loss statement and you take your net income and add back depreciation, amortization, and interest expense, which are all non-cash items, to your net income, that's your cash flow number. You divide that by the proposed loan payment, which is principal and interest, and that gives you a metric that the banks are going to look at historically. Of course, they look forward, but everything is based on historical performance. 2 years don't make a trend, 3 years do. 1.25 times of debt to EBITDA is really what they're looking for. So if your cash flow can cover a loan at least 1.25 times, that's a standard metric. It's not the only metric, but it's a good way to do what I call a back of the envelope analysis to determine where you stand.
So if you're putting a package together, would I recommend, and if you need more information on this, just get back to us on it or in the question, knowing that if you know you will cash flow and you can show what the true cash is that comes to the bottom line, add what you estimate the loan package will cost you on a monthly basis, you can do the ratio too. So when you go into the bank, you can say, I believe we're going to cash flow with the loan in a way that you're going to be able to say yes to that aspect.
Correct.
Other things that are challenges that I need to look at if I'm now on the side of going after a loan in this market.
Yeah, and along with the challenges, there's some absolutes that you should not do that can blow your chance to get a loan, and that will dovetail into what I'm going to say next. One of the things is, don't go out and buy a house, use up all your liquidity, your money in the bank for a $40,000 or $50,000 car or truck or whatever. Stay away from large expenditures, because if they degrade your cash, that's going to dovetail into the next thing that banks are going to look at, and that is how much do you have in reserves. prior to COVID, a bank would say, okay, this person can make a 20% down payment. You have say a $100,000 loan, that's $20,000 down. On top of that, they want to see it pre-COVID another 10% in the bank for reserves, rainy day fund, as it were, for the business or personal. That'd be 10,000. Today, most of the credit officers are looking, when they analyze a deal, for 20%. So if you put 20% down, they're going to want to see another 20% sitting in savings, business bank accounts, personal accounts on top of that. So you're really looking at 40%. Now, that money only needs to be there till closing for the 20%. And every bank's different, but usually they don't come back and police that after the loan proceeds have gone out.
So what you're saying is, for anybody that wants a quick understanding of what the term liquidity is, liquidity equals your reserves.
Liquidity equals the sum of the down payment and reserves.
Okay.
Liquidity is anything cash on hand, cash, savings accounts, and anything else that can be converted to cash in 90 days or less.
And that probably doesn't include antiques.
Antiques, grandmother's jewelry, your cars, gold, silver, no.
Okay. So
and let me add one tidbit here. Net worth doesn't really mean a whole heck of a lot. You see a lot of these real estate shows. Hey, I have a net worth of $2 million. Well, you have 5 cents in the bank. Sorry, no loan.
So I think if we have a glossary of terms that we're giving away, and we'll explain at the end of the program how to get them. But one of the things is you'll see terms like what is liquidity, what is collateral. The key terms you need to know that are financial terms, and we'll talk a little more about that as we move forward. Let's move on to the next slide. Knowledge is power. There's one of the things that I've always said is one of the keys to success is know the system, know how it works, understand the difference. We understand we have a question, someone's asking about the difference between what banks will look at and what investors will look at. And they're going to look at two different things. So in either case, you need to know the system. But the more you know about how banks operate, and we'll talk a little bit about this on this slide, the better you are prepared to find the right bank, which is part of the process, and to also take the deal home. Bob, jump in.
Yeah, knowledge is power is really important. I mean, don't go into a bank cold. Perform some research if you've nailed down through the process of elimination, which bank you're going to go to. Get an introduction to a banker, because going in cold, that's going to be tough. That's going to be hard. Know that the bank is going to be looking at the things we've been talking about here in the past. They're going to want to see what you have in the bank. They're going to want to see a robust, well thought out business plan. They're going to be looking at your credit. If there's any anomalies on that credit report, more than one, then you're going to need to explain them. There's certain floors they have on credit as well. So knowing the system is very important. In addition, there's a lot of regulatory requirements that the banks are under. When I was a banker, we used to have to take about 31 exams a year on regulatory requirements. One of those, Reg B, states that a bank has about 30 days to decision a loan upon receiving application. So there's some leverage that you as a consumer can use. Another one, Community Reinvestment Act, that banks aren't allowed to redline or take groups of people out of a jurisdiction just because of who they are and their demographics, and not lend to them. That could help you if you're a female, woman-owned business or a minority-owned business. So, knowing the system can really help. It's not necessarily going to get you a loan, but it's going to put you in a better position to discuss and be received by the bank.
So Bob, let's talk about that, because many people on the call are women-owned businesses and minority business owners. As you pointed out, it doesn't guarantee you get a loan, but why is that important, and how does that help you if you know the way the game is played?
Well, it helps you because when those laws originated back in the 80s and such, there was a heck of a lot of discrimination going on between banks and communities. And based on the color of your skin or your ethnicity or where you lived, they would literally draw red lines on maps and say, we're not lending in that area. Well, over time, and with the advent of protest and I guess congressional and action and such, it became law, and a lot of banks were hit with fines. And to this day, if a bank violates a CRA regulation, for example, they could be fined a heck of a lot of money from that loan officer all the way up to the CEO. And, part of being a banker is giving back to your community. So it behooves you to help those people who probably are providing most of the small business in the U.S. I mean, small businesses account for about 11% of GDP on a nationwide basis. So it behooves you to work with everybody, not just your wealthiest clients. And these laws and regulations kind of force banks to get there. But since they've been out there for quite a while, it's kind of a normal course of business. But, depending on where you are and who you know, it doesn't always occur.
I've made loan presentations with clients that were female business owners, and I was amazed. I made a presentation for a company, very sophisticated business owner, and the bank directed all the questions to her male COO and to me. He didn't ask her a single question, and she froze up. She didn't stand up for herself. And then when we did other presentations, we made sure she takes the lead. So stand up for yourself.
Yeah, don't take any guff from a banker. I know that's kind of funny sounding, but stand up, present yourself, be assertive, answer questions, and if you don't like something, pose a question back to the banker.
Yes, don't be afraid to ask bankers questions. As a matter of fact, one of the freebies we're giving away are 8 questions you can feel comfortable asking a banker. Also, there are 8 questions you need to know how to answer, but do some research. Bob, I used to do research on, I think it's bankrate.com, to see if banks were healthy. We went after a loan with a bank that should have said yes. And they said, you're not bankable. And then we discovered that their bank was on a specific list with the Federal Reserve, and they're not going to tell you that. So don't assume one bank that says no is saying no because you're not a good risk.
It could be that, if the bank does historically a lot of, say, hotel loans or franchise restaurant loans, they might be filled up and they haven't sold that portfolio yet. Well, per the FDIC and what they're allowed to lend in that bucket being filled, they can't make any more loans. But you wouldn't know that.
That's right. So we right now, we're working on several packages, and we've already, in one case, we believe we're already going to have 3 banks that will give us a term sheet. We'll explain that. And as a matter of fact, let's talk now the difference between a term sheet and a commitment letter, because that's knowledge is power.
Yeah, a term sheet is basically, we've done our front end due diligence on this deal. We like it. We think it works. And we want to go ahead and take this into underwriting and try to get it approved. That's a term sheet. And generally, if you have a savvy relationship manager or business development officer, then your term sheet should be pretty darn close to what your commitment letter is. And at least mine always were when I was a banker. And so the commitment letter means you've been through underwriting, your deal has been approved, and the bank wants to close your loan. So it's the formal legal document. You accept it, you move into closing, you get your money. You decline it or try to negotiate it, it's gone.
Okay, so I have seen, because in my book, I've talked about shop till you drop. I've seen term sheets that are very generous, and then the commitment letter changes the game. In some cases, it might be something as the bank suddenly finds out that they're going to be sold to another bank, and what was good for their portfolio before wasn't now. So a lot of things can happen, and that's why I think it's critical you shop more than one bank. As a banker, Bob, what do you say to that?
Yeah, I say nuts. What Bob does, and that's why we work well together. I'm more of a rifle approach. The banks that I deal with, I know how they operate. I have that knowledge is power. I know what their back office is like. I know the kind of loans that they like to have, and I know their credit policies. So when I look at a deal, I try and determine, is this going to fit one of my lenders that I've used? And I'm also hedging my bets, because a lot of the banks I work with were either employees that reported to me, they were junior credit analysts at the time that are now in a senior position where we worked hand in hand at other banks, and now they're scattered all about. So mine's a little different approach, but on some deals, and especially under COVID, you need to do both a spoon of Rich and a spoon of Bob. You need to be able to go out there and dial for dollars, as well as if you have some that are in your hip pocket that you think might make it, go to them too, because they're all looking at the process differently.
So that goes back to something we said before. Bob said, get an introduction and do your homework and know something about the bank. It's very unlikely that you're going to have the knowledge Bob does to do that rifle approach. For us, it's working great because Bob has banks that are saying, bring it to me first and let me see if we're interested. And I think we're in 3 or 4 situations right now where it looks like the banks you've recommended are going to take it home. And 1 or 2 cases where they told you right off, we're not interested.
And a no isn't necessarily bad, is it, Rich?
No, a no is, well, my approach is the first bank I go to, I want them to beat me up. I want them to teach me all the mistakes I make, so when I go to the second or third bank, I'm better prepared, I make changes, and look at this as a process, almost like you're a comedian, and you're going to go on a major Tonight Show, and you go do the small clubs to get your act together. That's part of the power of the process. Thanks for feeding me that one, Bob.
Sure, and the reason that, and the fact that you've been beaten up so many times by banks is why I am so much better looking than you are, but we'll leave it at that.
But Bob, you're a banker and I'm resilient. Let's move on to the next slide. Speaking of getting personal, that was a great segue to this one, Bob. Okay. So let's talk about that from your side, because there's getting personal, soft and hard side. The soft is you in terms of the presentation you make. The hard is your financial numbers as an individual. And Bob, I'd like you to share what you're going to look at when somebody walks in the door and sits down next to you to make a decision.
Well, first of all, I'm going to look them in the eye for 30 seconds and make them nervous as heck and make them sweat. But no, not really. I'm actually a squishy guy. Think getting personal with your banker as a job interview. And the hard and the soft are twofold. You're going for a job interview and you're going to your doctor for a physical. That's really what's happening here. The job interview is explaining who you are, where you've been, what you're trying to accomplish, and being able to articulate that professionally, succinctly, and in a detailed manner. The hard part, which I don't mean hard as in difficult, but is going to be, they're going to look at your numbers. They're going to look at your performance from your current profit and loss statements and balance sheets. They're going to crunch ratios. They're going to look at the industry. They're going to look at businesses similar size, compare those to yours. They're going to look at how well you're able to cover existing debt and proposed. They're going to look at reserves. Everything we've been talking about in the past here, they're going to look at it. So it does get real personal. And the most personal of this is it's also a marriage. It's a partnership. If the bank's going to be giving you 80% of their money, they're going to want to make sure that you're on the hook here. I know sometimes there's questions out there about, well, for my $300,000 loan or whatever, I don't want to guarantee it. Well, you need to forget about going to get a loan then, because as they say, the bank's going to want to make sure you have skin in the game along with them.
And there's a number of ways to have skin in the game. One of them is to be able to show what you've already put in, what you're going to put in moving forward, and that you're not coming into the bank to get 100% of the revenue you need for your great idea. That's not going to take you anywhere. And so it's important that's also part of understanding what a bank needs and what the requirements are going to be for a bank to say yes. And we know there's a big difference between the bank who is looking historically at what you've done. Show me what you've done, show me what you've done, show me how you've handled issues, show me where your character is, and an investor who's going to say, I don't care about what you've done. I want to know about the future. I want to know about where you're going to take it, but I still want to know about the fire in your belly. So, Bob, anything else you want to add to this? How about the 5 C's here in terms of getting personal?
Well, I mean, the bank's going to look at your character, and your character really is how you're performing on your personal obligations, and that all comes from your credit report. And there are certain floors, like do not expect to go in for a commercial business loan with a credit score in the 500s or low 600s. They're going to be looking for credit scores 700 above. I know some of the metrics with SBA are 680 and up, but if you have any delinquencies, any anomalies on there, they don't just go, hey, he has a score of 702, check, that's done. They're actually going to read your darn credit report. And if there are anomalies there, they're going to get into those, and you're going to need to explain them. So it's really what's in the report as much as what the score is. Capital, are you able to make the down payment? Do you have reserves? We've talked about that before. Cash flow, of course, in an existing business, you're going to have to demonstrate through historical financial statements, hopefully tax returns, because those are, or audits, those are the most credible, that you can repay debt. Collateral, security for the loan. What happens if this thing goes bad? Well, there's no collateral, no security. Bank's out of luck. They made a $500,000 loan or a $300,000 loan, went south, the borrower didn't perform, or the industry went bad. and they just ate $300,000 or $500,000. Collateral is going to be second mortgages on homes, maybe even first mortgages. It's going to be liens on existing buildings. Could be on what I call yellow machinery or heavy machinery. But it's not going to be forks, knives, and spoons, and like I said earlier, grandma's jewelry. So usually collateral is looked at on a one-to-one basis to the loan, and if it's less than that, then the banker's going to have to make calculations, and this will be in our glossary, and use a term called mitigation to offset that level of risk. So those are just some of the 5 C's that are really looked at by a banker.
And we have that whole list for you as another giveaway. We've got a lot of great stuff for you to absorb that will help you in your preparation for loans. And I think we can move on to the next slide. These are the financial options that are out there with financial lenders. And Bob, there's been some changes in EIDL. What's new? So what's new?
Yeah, on the EIDL, which is the Economic Industry Disaster Loan from the SBA, that they in the past used for snowstorms, hurricanes, floods, things like that. It's been changing almost by the month here lately. What's new is now under the EIDL loan, as it's called, the SBA will lend up to 6 months of working capital to a small business. And oddly enough, instead of you determining what that is, they're going to determine what that is, and there's a process for that.
So do you know if that's historical or whether your projections mean a darn?
Nothing means a darn. I know that you're sending in your tax returns, and that's going to be the main medium that they're going to use to determine what that is.
It sounds like they're looking into a crystal ball with people that may or may not have the expertise to do it, and you're rolling the dice to see how much you will get here.
In some cases, yes. Government guaranteed loan, government documents. Government guaranteed loan, tax returns, which are government documents.
So let's move on to 504, which is one of SBA's best programs, and it's juicy, but you got to be going after real estate.
Correct. The 504 program, usually there's a bank and a small business development center that's involved in tandem to do one of those. The bank usually lends 50%. The borrower comes up with anywhere from 10 to 20%, and then the small business development center will issue a debenture, which is a bond for the difference. They're blended rates. The bank has a rate on its 50%. The debenture has a rate on its debenture. Generally, you don't want to see a deal below $500,000 on this because it's just not worth it for anybody to do. Blended rates right now for a 504 loan are actually, for the debenture part, they're in the upper 2s. So if you combine that with a rate on a weighted average cost of capital basis for a standard bank loan, you might have a loan in the upper 3s or lower 4s. And they're 20-year loans. The debenture goes for 10 with a 10-year hard prepayment penalty. They don't lend working capital. They don't lend franchise fees. They don't lend on inventory, but they do lend on real estate. And
Bob, if you're going after real estate, this is probably one of the best options.
Yeah, it's an option compared to what you would go out in the market if you're going for a $5 or $10 million loan and getting the same sort of rate structure. Except being a small business individual, the 504 kind of plays in the same playground that those big loans do.
So let's jump to 7A, which we've found for most of the businesses we've been helping is the sweet spot. And Bob, share why.
7A is the garden. Whenever you think of SBA, you're really talking about a 7A loan. It's the garden variety SBA loan. It covers everything. It covers inventory, franchise fees, working capital, equipment. you know, the whole ball of wax is covered. You can do interim construction. You can do a refinance. You can do an expansion. You can buy a business with it. It's the garden variety catch-all loan, and but you still have to qualify for it, and you still have to present a well thought out business plan. But it's the sweet spot for banks, and you have up to $5 million in availability for it.
And one of the reasons it's a sweet spot for banks is how much SBA guarantees the loan. So the bank gets the interest rate, but the SBA is on the hook for a substantial portion of the loan if it goes south. That doesn't mean that the SBA is going to say, well, some you win some, you lose some. The SBA is going to be reluctant to keep you in the program if you're not bringing in them good loans. Anything else you want to add about that? And how about export import and some deviations of the theme here?
Yeah, I know we're running short on time here, so I'll just kind of rifle through some of this. Yeah, with SBA, you're getting a 75% guarantee on the 7A loan. It doesn't mean that the bank will, at the end of the day, make you a loan just because of that. But it's an incentive to do a loan they wouldn't normally do. And that's the whole reason the SBA is out there. The export-import loan, however, you can get up to a 95% guarantee if you're doing extraterritorial business from a location in the United States. And that's not selling drugs or anything. That's just, you know, actual business. We have a client, we're looking at that has technology that he may be selling to France and Mexico, that we may take advantage of that facility. And then you have the express loan that is for deals 350,000 and less, that is more of a grading process, that if you meet certain attributes, a bank would kind of accelerate the process to get that done for you.
And your next is your basic conventional loan, where the bank makes the loan directly to you without SBA. And
right. You know, the 504 7As, you're talking 20, 25-year loans, 10 if there's no real estate. You know, same thing with Express. With C&I, commercial and industrial, is what it stands for. Standard bank loans, 3 to 5 years. Principal plus interest, loan covenants. They're going to be looking at every move you make. Loan agreements, guarantor agreements, you know, just standard bank loans, what I grew up with working for Chemical Bank New York originally. And then within that, there's also ABLs, which are asset-based loans. You might have heard the term factoring or borrowing basis, lines of credit, things like that are based on receivables and inventory.
One of the things about receivable loans through factoring, they're not loaning on the basis of your credit. They're loaning on the basis of the credit to the asset. And that can be a real advantage for you in first of all, making the best choices of who to lend money to as a business in terms of terms. And secondly, making sure you get collections on it. And third, getting your money up front that otherwise you would not be able to get.
Right.
Again, know the system, know what works. I think right now, let's start taking questions.
I think that's an excellent idea, gentlemen. And we do have several questions. I'm going to start off with one that it's pretty easy, but it's one that I think needs to be answered because I think there's some myths out there surrounding it. And that is, I've heard that certain banks help small businesses with no documentation. Is there a list of banks or credit unions that do this?
Yeah, they're called pawn shops, MCA loans, and yeah, that's a myth. That's
Okay.
fake news. That's just not the case. Banks are federally regulated industries. There will always be documentation.
And Bob, if we look back to the years when banks were doing loans that were not good, solid loans, they got beat up for it after the fact. So the regulatory aspects of what banks need to do to make a loan are critical.
Yeah, one of the jobs that I was interviewing for after the crash of '08 was to work for the FDIC, and I was FBI vetted to shut down banks that had made bad loans after the crash.
Now, there are low doc loans, and that's loans at lower levels, and that could be express loans, but low ain't no.
Great answer, guys. Okay, I've got a couple of related questions here, which is, what types of institutions are willing to lend to a business pending launch? As in, we don't have any sales yet, we need the funding to launch. And a corollary question to that is, I've got a new business that I've started in 2020. Will banks support a new business right now?
Yes, and go
yes.
ahead, Rick. Go ahead.
But Bob, take it away, because we're doing loans for a franchise, for example, that has not opened its doors, 3 of them. But share why these are good loans from your perspective.
Well, I mean, more to answer the question whether they're good loans or not is that, 80% of the loans I've done over, say, since, I guess, 9/11 have been startup loans. And that's kind of what I specialize in. And those loans, the banks are looking at those, but you have to present a credible business plan, projections, show that you can repay the debt, and show that you are a strong enough guarantor they're willing to, excuse the pun, bank on you for that deal.
And it helps if you have experience in the industry. It helps if you know the demographics. It helps if you can show the need for why this business will work in that area. For example, a couple of them, it's because of the area and the type of franchise that we believe we're going to be able to take them home. They both happen to be in Texas. One is in Springs, Texas, and the other is a community, Bob, the other one's outside of the Dallas area?
Yes.
Okay, so that can help you a lot.
And that's exactly what the 7A loan is for, to make a loan that a bank wouldn't otherwise make. Your regular street corner conventional lender, they're not going to touch a startup loan. They're not in that business. They're in for existing businesses 3 to 5 years or greater. And the startup loans, those are pretty much relegated to the SBA.
All right. Another question here, also related, and I'm actually very curious to hear your answer on this one, gentlemen. Are banks more likely to lend to a bricks and mortar versus a click and mortar?
Click and mortar. So both of them have real estate?
I think, that's an interesting question. There's not a clarification there, but I'm assuming that it's an online versus just an in-store opportunity.
It doesn't work like that. Every deal has its own DNA. And yes, there are some banks that will only lend to brick and mortar because that's their model. There are some banks that'll lend to everybody. And there's some banks that are technology based. So that's where you have to perform your due diligence and either, work with people like us or go out there and seek who is lending in that arena. Because at the end of the day, whatever bank's looking at it, they're still going to perform deep due diligence on you and on your business plan. So whether you're making hard widgets in a building or you're writing code to program thermo kiosk or for AI, it doesn't matter. Do you have a strong, credible business plan that is supported with actual factual data, or is it all blue sky?
So in 2020,
yeah, because blue sky doesn't repay debt.
Yeah, it's all about repay debt. In 2020, service businesses can be very good loans. They can be very good loans because you may have recurring revenue from clients. You may be in a position where you have higher margins. But one of the things they're going to look at is what are your assets? And intellectual property is not considered an asset that the bank can collect on if you go south. How it used to be, Silicon Valley was the bank to go to for this, but things have changed. And if all things are equal and you can show them that you can pay back the loan, it almost doesn't matter anymore, except know the bank and know their comfort level.
All right, this is one I know a lot of people would like to know the answer to. And that is, if the stars align, you've done your due diligence and you've found a good bank and everything lines up, what's the projected wait time after submitting an application that a startup or a business could expect to see the actual funds?
Let me start off with, have you given them everything they need? Because one of the things that holds up a loan is drip, 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 giving the bank what they need to say yes when they go through the due diligence process. That's one of the things we're also giving away, a checklist of the things you better be prepared to do. And I'm going to let Bob take it from the point, okay, I have everything I want. The loan officer on the front desk likes the loan. What happens next, Bob?
Yeah, if you've submitted or if you've made application, which means you filled out the bank's application form and given them everything Rich was talking about, knowledge is power. Federal Regulation B dictates they have 30 days to turn that around. And that means to decision it. So that's your clock. So generally, my rule over these 39 years of doing this has been, once it's into a bank, expect 10 days to 21 days to be in underwriting. Once it comes out of underwriting, generally, if you get an approval, then it's going to be another week to go over the documents, go over them with your attorney or CPA or your advisors. And if that's good, then for a non-real estate deal, 30 to 45 days to close. For a real estate deal, 60 to 90 days to close.
Yeah, when clients have asked me over the years, I need my money yesterday, how much time will it take? And I'll tell them, not when we do it, not a day more than it has to or a day less, because everything has steps and a process involved in it. And on the 11th hour, a banker can say, hey, do you have an insurance policy to cover this loan? And the next thing you know, you're hunting down an insurance company and a doctor to do a physical on you for you to be able to qualify for the loan.
All right, guys, we have another question here. It's an interesting scenario. I own a building free and clear, operate a business in the building, and need operating/renovation capital. Is the asset-based loan or line of credit your recommendation?
No. Asset-based and lines of credit are based on inventory and receivables. If you have brick and mortar, there's no debt against it, then you do what's called a cash out, and you can do a renovation loan through the SBA, or depending on your strength, through a regular commercial bank, and get the capital. For a commercial building, the leverage rate's usually about 80%. So if you owned $1 million building, then you're looking at the possibility of getting as much as $800,000 for that.
You're in good shape. Yeah. You're in good shape if you own a building outright. There still has to be a comfort level that the bank doesn't have to take your building to get paid back, though.
But they are taking your building because it's going to be primary collateral. They will take a first lien deed of trust on that asset.
But they don't really want to have to take your building. They want you to pay the loan.
Right.
Okay. Rich, this question might be in your direction, since you've been an entrepreneur with so many businesses, but a lot of our viewers out here are asking questions about the best kind of banks for startups to go to, or very small businesses to go to. Is there a way to kind of sort through some of the banks and say, okay, what's my best target here for being a startup or a small business? What kind of banks should I go after?
The first thing I would do is talk to peers, is talk to other people in the community and find out, for example, I'm not pointing the finger at any banks, but very unlikely will a bank like Bank of America or Chase or Wells do a startup. Generally, community banks may be the best place to go, but you want to do your homework on that, and you want to find out. It's easy to find out, particularly if you're going to go the SBA route, by talking to the SBA office nearest to you and say, what banks are looking at startups? What banks are willing to do startups? And Bob, since that's been your arena, not mine, the startup world, what do you look for?
Well, it's what I stated before. I mean, and for startups, you're primarily, unless you have a rich uncle, you're primarily looking at 7A SBA, and it's going to be the same criteria. They're going to, you know, what do you got in the bank? How does the business plan look? Strengths and weaknesses. They're going to look at the whole picture. So for a startup, it's really not a mystery. Just you know, you even go to the SBA website at sba.gov and pull all of the SBA lenders in your region and start, you know, dialing for dollars. But again, knowledge is power. See if you can get an introduction into a bank.
Awesome. All right. I think we have time for one more here at least, maybe two. I purchased a failing business with confidence I could turn it around. But since I'm still in my first year of business, most banks won't loan money. And with COVID, having a loan would truly help me get through this. What do you recommend for a small business like me? I have no current loans, but I can't prove income since the business has yet to turn a profit.
Rich?
Well, I would say that's classic startup. And that's what the first thing I would want to be able to do is make the case of post COVID, and who knows when that's going to be. This is what we're going to do. This is what we can do today to do this. But you're in a tough spot there with that circumstances, because unless the business you bought, you said was a failing business. If I'm the bank, if I'm writing your narrative, I want to know how you're turning it around, why you're going to be able to make a difference. What are the things that you're doing today that are going to set you up for that? Now, that doesn't mean you're going to get it, but that at least shows there was a reason why you bought it. You were stuck in this situation. You need the capital to make it happen. And I'm going to bring in another point here that I want to get Bob's opinion. I've been put in this position a number of times when I've been a co-signer on a note, and I don't want to do it anymore, but co-signing might help you here. Bob, do you want to consider, what would you say about finding a good solid co-signer in a situation like
that? Before that, I'd find a good solid bookkeeper or CPA, because what's going to be suspect here is you can't prove your revenue. That's going to be a problem. That's going to be a deal killer. So there's alternative ways through sales tax reports and the franchise, and I don't mean franchise as in restaurant system, but franchise tax system, to try and substantiate through either sale taxes or that what your revenues have been. To get a co-signer, that's you're taking it all off of you and putting it on them. So that if you're in dire straits, that's maybe a possibility. But I'd start pulling some numbers and showing some proof first.
Well, speaking of taking it all off of someone, we are going to take all the burden off of you guys now, because we are wrapping things up for today. We want to thank everybody for joining us today. If we didn't get to your question, go ahead and submit them. We will either follow up or we'll address some more questions tomorrow, because this is a two-part webinar and we will have part two tomorrow at the same time. We'd also like to thank Hello Alice for the opportunity to collaborate with them to assist this great community. Watch your email for the link to today's session. Mark tomorrow's on your calendar. And if you want to refer back to some of the resources that, that Rich and Bob alluded to during this, some of the checklists and things like that, we invite you to visit our website. It's thecapitalmasters.com, www.thecapitalmasters.com. And there's a lot of great resources for you there. We're going to go ahead and sign off for today, but we look forward to seeing you tomorrow.